welcome on board Vinit Sambre and find out where is it that he's seeing any excitement in the market. Vinit, hi, morning. Good to have you on ET Now as always. Vinit, a
Hi,
lot
good
of
morning.
conjecture out there on, whether or not the mid and the small caps have peaked out for the year already. What is it that you believe? Because, for the amount of naysayers out there, there's a fair amount of resilience out there in these pockets.
Hi, good morning. I think anyways, my even my thoughts we have been proven wrong in a way. So I was believing that as the mid and small caps were rallying at some point, we felt that they have peaked out. But I think the rally continues. I think to a large extent there are two important factors which to me seems to be playing out. One, anyways, I think some of these companies they have been showing decent performance. Companies have been looking at margin expansion across a few of the segments which we are tracking. In terms of the growth, I think the segments which are linked to the broader capex side of the story, those are showing good growth. And anyways, I think the narratives is very strong given the factor that as we look towards the economic upcycle over the next few years, some of these companies are going to grow meaningfully from maybe $1 to $3 billion at what they are in terms of their business revenues. They could move to maybe 30-40% higher from where they are. So I think those excitement and the second most important factor is the liquidity which has been driving. I have been saying that this has been principally driven by the liquidity. When we look at the earnings growth and we look at the stock price performance, the P re-rating has played a much higher role in terms of the stock price performance. So I think to some extent one will have to take a call on liquidity as well. And till now we don't see liquidity easing out. There is enough amount of interest which is there in the small and mid caps. The segment is receiving a good amount of flows. And hence, I believe that maybe the downsides could be protected. The sector may see some consolidation. The segment could see some consolidation, but on the whole, the smaller dips will be bought into is what my sense is as far as the mid and small caps are concerned.
So, Vinit, I mean, considering there's a large pool when it comes to the mid and small caps, where is it that you find pockets of froth and exuberance, and where is it that you still think there is opportunity and value on the table?
Yeah, I think again it's slightly difficult, and we have tried to slice and dice the whole segments as per our our own the way we define these businesses. So I think in terms of the valuations being pretty rich as compared to the historical past, clearly the engineering capital goods, those businesses have seen valuations rise way too higher than maybe the next 1 or 2 years of fundamentals. They are pricing in stronger growth continuing or sustaining for the next maybe 4 5 years. And assuming that the country goes through the economic upturn, we have strong policies, we have the capex momentum sustaining. I think these valuations could sustain. Otherwise, if there are any risk to those, then I think these valuations could also see some bit of easing out. So I think clearly this is one pocket which is really showing up in terms of being most expensive. And I think largely that has been the driver of outperformance in a big way. When it comes to the second category, consumer discretionary as a category, while it is expensive, but it has always remained expensive. It is not that this is a new high which these companies are trading at. The businesses are seeing some amount of slowness because of the overall consumption being slow largely, but still the valuations have not seen correction as much as the businesses have slowed. So I would say to some extent we are seeing the valuations there slightly on the higher side. While saying that, I would still say that consumption is one pocket which we are watching closely, and maybe at reasonable valuations we would be open to sort of look at taking exposure in some of these companies because we are believer of long-term consumer trends as far as Indian markets are concerned. So I think clearly these two pockets are the pockets where we find the valuations to be slightly frothy. And then there are pockets like pharmaceutical companies, insurance companies, NBFCs, banking. These are the pockets which are still maybe reasonable or trading at less than their average valuations. So we are trying to create a sort of balance the portfolio by having mix of both these categories, but being trying to be more rational in terms of our approach when it comes to sizing these businesses in our portfolios.
Hi, this is Anisha also joining in the conversation. What about Pharma? What within Pharma looks good to you?
So I think clearly, sorry, yeah. So I think clearly, when we think of pharma as a sector, we are looking at pharmaceutical companies. Hospitals are also part of the overall healthcare as a basket. While hospitals in general they have been doing well, but the valuations there are they are almost full there. But in terms of pharmaceutical companies, I would say that these companies are now seeing margin expansion driving their earnings growth after last 2 3 years of maybe mediocre performance. The valuations have still not caught up to the expectation changing in terms of the earnings. And broadly, I would say that companies which are catering to both the Indian domestic market and the international markets are the ones which we are sort of focusing on as far as the pharmaceutical companies are concerned.
Vinith, hi, morning. Let's also get in your take on how you'd look to really capitalize on the opportunity within the entire defense space, railways, PSUs as a theme that have really had a stellar run up so far. Do you think that there is more to go, or do you think that already the run up has been too fast, too furious?
No, as I said, I think these are the segments which have definitely seen very positive change in the fundamentals when it comes to order inflows, when it comes to growth in the business, or when we in general think of the opportunities which are maybe there in terms of the plans which the government has across all these categories which you mentioned: defense, railways, power. So I think all of these categories we have seen a massive amount of stock outperformance over the last maybe year and a half. So when as we stand today, I think as I said in my initial remarks, the sustenance of these higher valuations would largely depend upon the fact that these companies continue to get the momentum as far as the orders are concerned, and which we as of now are sort of having that expectation that this should continue. Maybe we could have some blip towards as we are approaching elections, and basically beyond elections, I think once again maybe we have a stability in the government, and then I think these order momentum should continue. So I think we are looking past this next 1 year as far as these businesses are concerned. But let me also highlight that any kind of risk which maybe comes about because of any of these macro factors which leads to slowdown in the order momentum, I think that those are the risks which anyways are there. But otherwise, for me, I think these are the businesses which we are having exposure in our portfolios and will continue to own as of now.
Vinit, what about the entire consumption theme? I mean, the auto index has hit a record high today. The Nifty Realty Index has been on a 15-year high. The luxury, spends have been doing well. How should one play the consumption theme?
So clearly, I think consumption, again, I would like to break it up into two parts. One, the consumption, which is principally more oriented towards the rural side of the economy, or as we say, the entry level products. Those are still not caught up in terms of the growth prospects, because I think we are seeing that the population there has been affected because of inflation, and they are not coming out and fully sort of spending as far as the consumption is concerned. So I think that is something which we believe that over the next 1 or 2 quarters, things should change as some of these inflationary pressures even out. And as time passes, I think people get adjusted to the new price points. And anyways, I think as we have seen improvement in the MSPs and the government spending, which is likely to take place, I think those should help recovery as far as the rural side is concerned. So I think that is one category which we have been in anticipation of recovery. We have a sort of, let's say, positive view, because the valuations there are also reasonable across the companies which are catering to those part of the consumption. Coming to the urban side of the consumption or the premium end of the consumption, we have seen the top, let's say, retail mall, which is in a way, it showcases how the trends there. We are seeing that the consumption there has been decent, and in terms of the valuations, I think these companies are trading at decent valuations. So I would say, and then there are categories which are seeing slowdown in consumption, like QSR, and maybe some of the other discretionary categories, but there the valuations are not cheap. So I think we have to create baskets of consumption where we find valuations are reasonable and maybe there is some expectation of pickup, and those are where we are focusing on. As far as your question on auto is concerned, we have been positive on the auto sector because of the cyclical recovery, which we believe should sustain over the next 1 or 2 years after the sector has gone through slowdown during the COVID and a year after that. So I think that's how we are trying to sort of think about the overall consumption as a basket.
Vinit, good to have you on board. Thank you for sharing with us your market insights. We'll slip into a very quick